Hi everyone, how are you doing? So today I will show you how to prepare opening statement of financial position or first financial position. If you read IPSAS 33 paragraph 15, then you are required to prepare this first financial position. And then paragraph 20 states that when you are preparing first financial position, you recognize assets and liability. You recognize assets and liability whose recognition is required by IPSAS. You do not recognize, like you you de-recognize any assets and liability whose recognition does not permit or is not permitted by IPSAS, and then you reclassify. So I will show you how to do all those, and then apply IPSAS in measuring all recognized assets and liabilities. If you are on cash basis, if you are on cash basis, if you are on cash basis, then you are required to adjust your accumulated surplus, the financed by part, to recognize or to adjust. Yes. This statement, while you are on cash basis, was called statement of financial assets and liabilities. Financial, I mean, you are only dealing with cash. With cash, this was interest, this was bank balance, cash balance, third-party deposits, and again, represented by is just the balancing figure on top here. So, we have this cash basis, we have this cash basis statement. This is an example. Entity ABC is a national government entity that is transitioning from cash to accrual effective July 1st, 2024. So on July 1st, you are required to prepare first financial position. You have this item, these transactions or amounts in your statement. Your cash and cash equivalent total is 31. Your salary advance is 200. Your third party retention is 1 million, and then the balance is 30,725,000, of which here is the balance. So the total assets are 31,725, 31,725,000, and the net assets is 30,725. We already have these figures. We already have these figures. So this is the additional information which will give you, or I will show you how you will adjust. We will show you how we will adjust using these adjustments, using these adjustment. So let us start with number one. Let us start with number one. ABC lists its ground floor to Equity Bank and Daima Limited. Those are two different entities. As of 30th June 2024, the previous year. So here, this entity's years ends on 30th June 2024. So ABC or Equity Bank had prepaid 500,000. If someone prepays you, that person owes you. That person, you owe that person. You owe that person. You are debtor to that person. So prepayment, someone has paid you in advance. Someone has paid you in advance. So how do you treat that? So it is 500 liability, 500,000 as a liability. Uh, this one we are done with it. And then Daima Limited had an outstanding rent. So this one hasn't paid you, it's a receivable. A receivable, so you record 250,000. If you look at this statement of mine, you will see that there is the cash basis, which was the previous cash basis. There is the adjustment. So we will be recording the adjustment in the adjustment. And then finally, we will get our opening statement. Sorry for that. We will get our opening statement. So we are done with point number one. Let us go to point number two. As of 30th June 2024, ABC stores had consumables inventory worth Kenyan shillings for 50,000, but then replacing similar cost of 500. So inventories are measured lower of cost. So inventories are covered under IPSAS TOLIF. We normally cover inventories under IPSAS TOLIF. Lower of cost or net realizable value. Lower of cost or net realizable value. So that is 450,000. 450,000. That is 450,000. So we are done with number 2. Let us go to adjustment number 3. ABC medical insurance runs from 1st October to 30th June, 30th September. So if your year ends 30th June, you have how many months? Additional months of 3 months. So the annual medical cost settled on 1st October 2023 was Kenya shillings 24 million. So you paid everything up to 30th September the other year. So how many months have you prepaid? July, August, September. So if you say 3 out of 12 times 24 million, times 24 million, that amount is 6 million, which is a prepayment, which is an asset, which is a prepayment and also an asset. So that is 6 million. This is not a liability. The equity one was a liability because someone prepaid you. This one, it is you who made the prepayment. The prepayment. ABC Commission at 10th floor Plaza on July 1st, 2023. The billing cost was Kenyan shillings 400 million and has a useful life of 50. So 400 million divided by 50, which is 8 million. So the depreciation is 8 million. This is an investment property. When we are talking about investment property, it's covered under IPSAS 16. It's covered under which IPSAS? IPSAS 16. Investment property we measure using two ways. We measure using two ways. Fair value model or cost model. Fair value model or cost model. How can we differentiate investment property from property, plant and equipment? For property, it is the purpose, the use. Property, plant and equipment, the purpose is for administrative. You are using that building or that non-current asset for administrative. But then investment property is when you use that property for capital appreciation or rental income. And in this case, we call it commercial property or commercial plaza. So the aim is maybe for rental or for capital appreciation. And therefore, we will recognize, even though IPSAS 16 recommends you to use fair value model, but in this case, you can see ABC chose to use the cost model. The cost model. Therefore, we will record 400 million minus 392 as our investment property. 400 million divided by 8 million. So we will arrive at 392 million. 392 million. We are done with that one. Let us go to number 5. ABC block was built in the late 70s and no records are available. So for you to measure an asset, for you to measure an asset, you have to use 3 criteria, of which all of them must be there for you to recognize an asset. Number 1, you own or control. Own or control. That is 1. 2, you should be able to reliably measure. 3, you should enjoy economic benefits or surface potential. So one of them is missing, which is that one you cannot reliably measure, and therefore we will ignore this one in our books. We will ignore number 5 and just disclose in our books. So let us go to number 6. On 30th June 2024, ABC received data analysis program software as a donation from the Danish government, whose fair value is shillings 20 million. The software has an indefinite useful life. So what will we record? 20 million. We will record the 20 million because this is an asset donated or given to you, which you can reliably measure. So assets can be tangible or intangible. Tangible is you can touch and feel. Assets can also be current or non-current. Current is you classify when you are using for or sell for consumption or sell within 1 year, or you are to receive within 1 year. Anything more than 1 year, then it is a non-current asset. Let us go to number 7. ABC planted commercial trees for sale whose fair value is Kenyan shillings 50 million, but will require mandatory selling cost of Kenyan shillings 5 million. So this we measure under IPSAS 27. We measure and recognize under IPSAS 27, whereby it guides us to say to measure using fair value less cost to sell. Fair value less cost to sell. So our fair value is 50 million. Our less to cost to sell is 5 million. What will we recognize? 45 million. 45 million. Remember, there's many types of biological assets, but the only exception under biological assets, yes, trees are biological assets, but bearer plants will be recognized under property, plant, and equipment. All other biological assets will be recognized under biological asset. So the IPSAS is IPSAS 27. Let us go to number 8. ABC has leased one go down in industrial area. The lease contract ends June 30, 2024, and the lease liability as of July 1st is 5 million. In this case, this is just an example. Even though leases has 4 transactions and 4 ways to, and we will recognize in performance as finance cost, as depreciation, and a position will recognize right of use and lease liability. But in this case, what we will recognize is the right of use asset, the right to use that asset, which is 5 million. Sorry, the right to use that asset. And the lease liability, we will recognize how much? 5 million. This is an assumption and this is for demonstration purposes. We are introducing the right of use asset and the lease liability. The IPSAS that covers leases is IPSAS 43. IPSAS 43. In the old days, we used to use IPSAS 13. IPSAS 13. So we are done with 8. Let us go to 9. ABC has retained 1 million. ABC has retained 1 million as retention deposit for office refurbishment. So if you look at our cash basis statement, already we have captured that 1 million retention. So the assumption is you have already captured that. And then number 10, as of 30th June 2024, ABC had advanced Kenyan shillings 200,000. Again, receivable from exchange, we have already covered that under the cash basis. So if the information is accurate, we won't change. 11, ABC owes its contracted staff Kenyan shillings 10 million as gratuity. No cash has been set aside. So this one, we will recognize employee benefit, the 10 million. We will recognize the employee benefit, the whole 10 million. That is number 11. Number 12 is ABCO suppliers Kenyan shillings 100 million for consumable goods supplied during the year ended 30th June 2024. So we will record these spending bills or payables 100 million. 100 million. This is what we will record. Number 13, ABC received laptops worth 50 million and has yet to pay the supplier. So we will adjust this. And write 115 million. We will add 100 million plus 15 million. Again, there is a double entry for this, 15 million for PPE. 15 million for PPE. We are done with that. Let us go to number 14. By the end of financial year 24-25, ABC had not yet received part of its exchequer. So there is what's called under IPSAS 47, there is binding arrangements, whereby you can enforce an agreement through legal or something that is equivalent. So you expected to get money from the national government. Can you take that government to court? Is there a law that says that you will receive that money? Did the budget period lapse? is there a history that says that you can get that money from the national government or the national treasury? If the answer to that is no, then you will not recognize in your books. Again, there is an indicator that indicates or gives you signals that you have received this money. When we are preparing these financial statements, we don't just prepare as the year ends. The year normally ends as 30th June, but then we have period before we prepare the financial or the financial statements are signed. If you read IPSAS 14 events after reporting period, you will find that there are adjusting events and non-adjusting events. If before the report is signed you receive those allocations that belong to the previous year, then you will recognize as a receivable. Otherwise, if the budget lapses and by the time the report is signed you didn't receive that money, then you won't disclose or recognize in your books. That is, the budget has lapsed, and it's my assumption that we won't recognize this 120 million. In Kenya, it's also a practice where we normally get some money at the end of the year, say 15th July. Normally, it's a culture. Even though PFM doesn't allow, it has been our culture to treat such money that you will get by 15th July as and belonging to the previous year allocation and the previous year allocation. 15. By June 30th, 2024, a cash transfer for the elderly worth 10 million had not yet been disbursed. This is a liability. Based on your initial practice, you used to promise the elderly 10 million, and therefore it is a liability to you. It is a liability to you. Social benefits, we will record how much? 10 million. Social benefits, we will record 10 billion. And finally, our final adjustment is part of the cash in the bank. You have the 30 million you have in the bank. 20 million is from a development partner which will be used for personal training. So there is a condition and you are told to use it for personal training. By August 24, 10 million and another 10 million for 2025. So that one we will treat as deferred income because there is a condition attached to it, and as you fulfill those conditions, then you will recognize as a revenue. You will recognize as a revenue. So let us do the adjustment. So we started with our cash basis, and then there is this adjustment, and then there is the opening statement. So what are we supposed to do? You will add these figures. The cash basis plus adjustment will give you the opening balance. So how much was our cash and cash equivalent? It is 31,525,000. 31,525,000. How much is receivable from exchange? It is 200,000 plus 250,000. That is 450,000. That is 450,000. This one is dash, no figures. How much is our prepayment? It is 6 million. 6 million. Our prepayment is 6 million. How much is our inventory? 450,000. So let us total our current assets. Let us total our current asset. So we total our current assets. We total our current assets 31,525,000. 31,525,000 plus 450,000 plus 6 million. 6 million plus 450,000. That is 38 million. 38 million 425,000. 38 million 425,000. How much is our property, plant, equipment? 15 million. 15 million, because here is zero. All of these transactions are zero. Again, right of use is 5 million. 5 million. How much is our intangible assets? 20 million. 20 million. Remember we said cash basis plus adjustment will give you the opening balance. How much is our investment property? 392 million. 392 million. How much is our biological assets? 15 million. 15 million. So let us total these figures. 15 million, 15 million, 15 million plus 5 million plus 20 million plus 392 million plus here was 45 million, sorry, 45 million. Here was 45 million, 45 million. So plus 45 million. So the total non-current assets is 477 million, 477 million. So how much is our total assets? How much is our total assets? 477 million plus 38,425,000. 38,425,000. So our total assets is 425,000. That is our total assets. So let us go to liabilities. This is dash. So ni 115 million. 115 million. Refundable deposit is 1,500,000. 1,500,000. Our current lease liability is 5 million. Our current lease liability is 5 million. Our deferred income is 20 million. Our deferred income is 20 million. Our employees benefit is 10 million. Our employees benefit is 10 million. Our social benefit is 10 million. Our social benefit is 10 million. So how much is our total liability? How much is our total liability? Let us again do the calculation. 115 plus 1,500,000 plus 5 million plus 20 million plus 10 million plus 10 million. That is 161 500,000. 161 500,000. 161. So our total assets was 515 425,000 minus 161 500,000. So our net assets is 353. Our net assets is 353 925,000. 925,000. The question here is how much is our accumulated surplus? We have started with this figure. How can we arrive at 353? How can we arrive at 353? This is the formula you will use. We normally say accounting formula is equal to assets is equal to equity plus liability. Here our equity is net assets. Our equity is net assets plus liability. So if you make the subject of the formula our net assets and you remove liability, we will say net assets is equal to plus asset minus liability. So whatever we have calculated here as liability, it's a minus. Whatever we have calculated here as assets adjustment, it is a plus. So finally, if you start with the opening balance of 3725 and add all asset adjustment and minus all liabilities, you will arrive at the same figure, which is 353,925,000. Thank you for watching. Please follow me for more videos like this. I normally cover IPSAS and financial reporting. Thank you for your time. Hope you have understood the concept. Enjoy your day. Thank you and enjoy